He walked me through.
All right. So Senator McDonald, you are here. I'm going to call this meeting to order. This is the Senate Finance. This is January 21st. And we are going to start out with our annual tax expenditure report. This is when we take a look at all those tax credits, tax exemptions, tax things we've done and look at how much they're costing us in deferred revenue. So Graham's going to do that. And then I believe we're going to take a break. And then we have the downtown tax credit and clothing and footwear, which is the one we kind of hone in on this year. And given last year and where we are this year, it's probably a good year that one is up for really in-depth review. So we're going to get both. So Graham, the floor is yours.
Thank you, Madam Chair. Thank you for the committee for having me this afternoon. My name is Graham Campbell. I work at the Joint Fiscal Office, and I'm here to present, well, three things. Our tax expenditure report, and then our two full reviews that we did for the 2021 tax expenditure report. So I'm going to share my screen here. And can everyone see that?
It's up. You might make it a little larger if you can. Oh, now it's big and large.
Okay, so I'm going to begin. I think the first chunk of time here is dedicated to just this tax expenditure report, and then the second half after the break is dedicated to the reviews that our office did on two tax expenditures. But first task is going to be the overall tax expenditure report. This is a biennial report, so it comes out every 2 years and is essentially a cataloging of all the tax expenditures. I'm going to omit Senator Brock here. It's a cataloging of all the tax expenditures we have in our tax code. I'm just going to go here. So when we talk about a tax expenditure, what exactly are we talking about? The technical definition is it's a statutory provision which reduces the amount of revenue that would otherwise be collected from a certain tax. So it's done to encourage particular activity like investment or savings, or limit the amount of taxes collected from certain groups of people. So as Senator Cummings said, examples of these are tax credits, deductions like the earned income tax credit or the Social Security deduction, or we're talking exemptions from the tax base. So for example, clothing and groceries are exempt from the sales tax base. And so this report is a sort of group effort between JFO and the Department of Taxes to estimate when possible. That's key. So this report is kind of an evolving document every single year. We try to make improvements to it every time we release it. But you'll notice as I walk through here that lots of these tax expenditures are just not estimated because there's just no data available to even make an accurate estimate. For example, there's the sales tax exemption for tracked vehicles. There's just no information available that would give us a reasonable guess at what those sales might be in Vermont. So rather than put an inaccurate number out there, then we just leave it not estimated. Are there any questions so far?
Yes, please. Madam Chair, thank you. I just wanted to double check a fundamental definition. I've heard people talk about these sorts of tax expenditures as tax deferred as well, or tax foregone. And I just wanted to make sure. I'd always thought of them as foregone entirely. Do we ever actually just defer them or claw them back later if someone fails to live up to something? Or maybe that's opening up like TIF questions or something, but
I think that's probably TIF as much as anything.
It's a good question. No, I mean, I think what you were thinking is more correct. And what's cataloged here is more foregone revenues, not deferred. There are lots of things that sometimes get deferred. So for instance, like not deferred, but like a carryover on the income taxes to future tax years. That's not considered a tax expenditure. And maybe it's good to stop and take a second, just talk about, tax expenditures, what it is, and what it is not. Generally, what's in this report is, when you look at the statute, there are sections within statute where there are specific exemptions from the tax base, or there's specific, things in the code that are credits that are basically, reducing the base, within that section, and or reducing the tax liability of that section. What a tax expenditure is not is things like a program. So for instance, current use is not considered a tax expenditure for the purposes of this report. That's something that, I've received disagreement about, but the reason why that's not in this is it's considered more of a program than it is an actual tax expenditure. And then some things like things where it's a part of, it's just not included in the tax base. So services on the sales tax are not a tax exemption, just because services are not considered tangible personal property. And so we don't estimate or consider the fact that we don't tax services as a tax expenditure. So what it really is it's a little more fine-tuned, where it's, you might look at the sales tax section and there's an actual subchapter within that section that says sales not included or sales not covered. And it lists out a number of various things that should not include in the tax base. That's kind of the more narrow definition we're talking about here.
Can I ask a quick follow-up, please?
Yes.
So you had just mentioned use value appraisal, and I'm just trying to make sure I'm remembering it right, that although to the individual who receives the tax benefit, a reduced property tax, to the town, it's not, to the town, for instance, they're made whole by the states, right? So there's no foregone revenue at the municipal level or the ed fund. We fill in for the taxpayer or not. Senator McDonald shaking his head.
I don't want to speak to that. I'm not an expert on how property taxes and how the current use program comes into place. I don't want to get ahead of my skis here, but I
can wait if you prefer.
I can reach out to someone at JFO to confirm that that's correct. But current use is the example I put forward because it's not listed in the statute as something as it in the same way that an exemption for libraries is for the from the grand list. It's just a different regime for taxing different types of properties. So it does in effect reduce tax liability, but I've heard arguments that current use is sort of the correct way to tax this type of land, and so it's not. They might not consider it part of the property tax, for instance. So that is something that is quantified. So it's not in the tax expenditure report, but I think the property valuation and review report from the Department of Taxes does quantify the value of the current use program. I think it's around $60 million-ish. So,
thank you.
Okay, so if there are no other questions on this slide, I'll sort of dive into.
Okay, I can only see Senator McDonald.
Could you just review once again the difference between a tax credit and an absolute tax credit?
A tax credit and an absolute tax credit.
Just thinking about the earned income tax credit, for example.
Are you referring to refundable versus non-refundable?
Oh, refundable. My failure. Could you explain the difference between a refundable tax credit and a tax credit?
Absolutely. So a tax credit is something that reduces one's tax liability, not reduces their base. It reduces the overall tax liability. And refundable credit is a credit that reduces someone's tax liability, but if the individual or entity's tax credit is more than the tax owed, the state issues a payment. So the earned income tax credit, if an individual has more earned income tax credit than they do tax liability, then the state issues a refund. You can have negative tax liability, another way of saying it. And so that explains why in our income tax, for those making, I think it's less than $25,000 overall, the effective tax rate is negative for those groups because of the earned income tax credit. A non-refundable tax credit is where if your tax liability is, or if the credit is larger than your tax liability, the credit wipes out your tax liability, but it cannot go below zero. So the state is never issuing refunds from a non-refundable tax credit. However, there is the possibility of carry forwards for certain non-refundable tax credits. So you might wipe out your tax liability in 1 year and have some remaining credit, and then you can carry forward that credit to a future tax liability, the remaining credit.
Thank you.
Brodkin.
Seeing that we're about to go into the specifics of the tax credit, and we're sort of talking generally up until now, I'll raise the gnarly question of where does VEPSI fit into tax expenditures?
Great question, Senator.
Not tax credits.
It is not in this report. We discussed it this year whether it should be added. It's never been included as a tax expenditure in the report. And that, I think the primary reason for that is we didn't want to, if it has never been considered one, and we just didn't necessarily want to add it. But the second part is it behaves a little differently than, say, an income tax credit, where the income tax credit reduces the liability, whereas with VEPSI, it is based on how many jobs or how much capital expenditure they make. The tax department issues sort of a payment against their withholding account. And so it's slightly different than just, on the form you're filling out, how, like on your earned income tax credit, you fill out how much your earned income tax credit was and it reduces your tax liability. Whereas with VEPSI, it's operates a little bit differently in that it's sort of a payment from the tax department. The way they issue that payment is against a company's withholding account. I think that one is also sort of fits into the program side of things, where it's more of an actual economic development program. But even still, I think there is room for interpretation about how this could be a tax credit or a tax exemption.
So is it fair to say it's not included in this presentation because it's not a tax credit? It acts as a cash grant. Is that fair enough?
Yeah, I think that's 85% correct. The way it behaves is kind of a credit against the withholding account. So, but what that ends up doing is it ends up spitting out a payment from the tax department in most instances. So,
Betty, I would like to move us off VEPSI. It's not in this report. We have
Because it's
spent
not a tax
days
credit.
on VEPSI, and we will, if you would like, spend days on VEPSI again. But I'd like to let Graham get through what is in this report, because I'd like to get us home before 8 o'clock tonight, or at least off this screen. Okay, Graham.
I can follow up offline with if there are any more questions about it.
Okay. Well, I think we annually take a look at VEPSI, and I think we probably will again this year as we start looking at economic recovery and, the best ways to achieve that.
But we're not looking at it here because it's not
Yeah.
a tax credit.
It is not strictly a tax credit or exemption.
That's fair to say. Just wanted to highlight that as part of this tax expenditure report, there are reviews, and that's in the back of the report itself. I think it was Act 134 of 2016 laid out for the Joint Fiscal Office and the Tax Department a schedule for doing expedited, as they're called, reviews and full reviews of tax credits. And this year, the reviews that were scheduled to be done were tax expenditures related to housing and community development. And so the full reviews we did this year, the Downtown and Village Center Tax Credit Program, because that's the biggest one amongst this category. And you might be asking why the clothing and footwear sales tax exemption is in that category. It's not. It is actually slated for 2023. But the reason why we did it this year was because there are a lot of tax expenditures related to the 2023 schedule. I think they are related. It's tax expenditures related to reducing the tax liability on low-income families and for exempting necessities. And so there are many. And so in order to sort of give us more time to look at other stuff for the next report, we did the clothing and footwear sales tax exemption after consulting with with Senator Cummings and with the chair of the Ways and Means Committee, since this issue has come up in the past couple sessions as well. And then there are 3 expedited reviews related to housing and community development. I think they are the affordable housing credit, the charitable housing credit, and the credit for a sale of a qualified mobile home on the income tax. So, without much further ado, here is the sort of breakdown by tax type of our tax expenditures for fiscal year 19. So total tax expenditures totaled $517.2 million across all tax types that we can estimate. And I make a note here that I exclude the Vermont standard deduction and personal exemptions on the personal income tax, because those, while they are tax expenditures, they're more just to better define the base, I think. But if you include those, you add another about $220 to $230 million on top of this in the personal income tax. But it just would skew the numbers a bit if I included those. But the majority, the half, or more than half of those, that 517 is on the sales and use tax. About 95 million is on the property tax. And I'll get into potentially why that number might be a little bit off when we talk about the property tax exemptions. The personal income tax, excluding the standard deduction and personal exemptions, was 77.4. Motor vehicle fuels and the purchase and use tax, $37.5 million there. The bank franchise and insurance premiums tax is 29, and then the remainder are about 10. I'll dive into each one of these taxes.
Okay, great. Then I'll hold my question.
Yeah.
Okay.
So the personal income tax, what is new and notable in the report this time? So the big thing is that the tax expenditures that were introduced as part of Act 11 in 2018, this is the sort of big decoupling and the big overhaul that you all did a couple of years ago. Those are now what I'm saying as fully online. So we have a full tax year of information on how much those exemptions cost. Before, we're just sort of estimating based upon our modeling. The key ones there are the Social Security exemption. So we have a full sense of the cost of that one. The personal exemptions and the standard deductions, which were previously federal flow-throughs, because prior to that act, federal taxable income was the starting place for Vermont taxes. And so in effect, what we were doing was picking up the federal personal exemption and the federal standard deduction. And so Vermont, by passing decoupling and introducing its own personal exemptions and standard deductions, kind of brought those tax expenditures onto its books, for lack of a better term. But in effect, they're not actually that much different than it was before. And then another one there is the charitable tax credits. This was the 5% tax credit up to $20,000 in contributions that sort of replaced the charitable deduction that was previously flowing through from the federal taxable income starting place. The second thing is the capital gains exclusion. If you recall, I think it was in 2019, the legislature put a cap on that exclusion. So for the newer members in the committee, you on your personal income taxes, you can take an exclusion of your capital gains income, either in 2 ways. It can be a $5,000 flat exclusion for any type of capital gain, or you can take a 40% exclusion for certain types of assets. And those can be business properties sales, they could be investment property sales, timberland sales, farm sales, but not stocks and bonds or any financial instrument. And previously that 40% exclusion used to be unlimited, but the legislature put in a cap in 2019 of $350,000 in exclusion, which means that for any capital gains over $875,000 in a given year, you're not eligible for any more exclusion. And so the tax year 20 was kind of the first year where that came into effect. And then tax year 20 was also the first year that the medical deduction was effective full year. So that was something that was passed by the legislature also in 2019. And the way that worked was essentially it's your federal medical expenses, what you're deducting there. But we limited it a little bit by saying you had to subtract your standard deduction and your personal exemptions from that amount. And then for those in continuing care retirement communities, their entrance fees and their monthly fees were not eligible to be deducted. So we have, for all the recent tax exemptions and stuff that have been passed in the past 3 years, we have a sense of what they cost now in actuality, because we have a full year of data.
Okay, Senator Sorokin.
Can we get, I don't want to take up too much time, but can we get a memo on these recent tax changes, what it was projected to cost and what it now appears that it costs?
Yes, I can put that together. I can speak to it as I'm kind of going along here, because I'll touch upon that when I'm presenting on the next slide here. But I'll put a little note together for the committee.
Thank you.
Okay, so here are the fiscal year 2020 personal income tax exemptions or expenditures. Again, this does not include the Vermont standard deduction and personal exemptions. In total, they cost $77.8 million. And the biggest one, as it has been in the past, is the earned income tax credit at $26.5 million. And that number is a little bit smaller than it has been in the past because the economy was pretty good, and this generally tracks the economy. If the economy's not doing so well, you're likely to see more earned income tax credit going out the door. The capital gains exclusion was $18.8 million. Within that exclusion, there's the 5,000 and the 40%. The 5,000 exclusion is about 1/3 of this cost, and the 40% exclusion is about 2/3 of the cost. And so at the time when we made the change of the cap, we estimated that this would raise about $5-ish million to the state. But that was based upon tax year 2016 capital gains, when we know that tax year 20's capital gains were quite a bit higher than that. And so I haven't modeled this because I don't have the tax year 20 data in our modeling software. But my guess is that rather than this change raising about $5 million, it probably raised closer to $6 to $8 million. Another way of putting that is if the legislature hadn't capped this 40%, then this capital gains exclusion would cost somewhere in the neighborhood of $22 to $26 million. Moving along to the charitable tax credit, it costs $9.28 million in tax year 20. That one, I think we estimated that cost to be about $11 or $12 million at the time when we passed it. But that estimate was based upon some pretty conservative estimates about what non-itemizers would give to charity. And it turns out that non-itemizers on their federal taxes gave a little bit less than what we thought. And so that's how that ended up. The Social Security exemption was passed in Act 11 in 2018, and we estimated that was going to cost about $5 million. And the Social Security exemption, the medical deduction, are the two newer tax expenditures that keep me and Steve Klein up at night, because the growth of these two tax expenditures is pretty interesting. So if we model how much the Social Security exemption cost back in 2018 when it was passed, it was about $5 million. So about 2 years later, it's added $1 million more. So right now it's adding about an extra $500,000 per year in foregone revenue. And the reason that is because Vermont's a relatively older state, and we have a lot more people joining Social Security nowadays as the baby boomers retire. And the second part of that is because the newer recipients of Social Security, as they join Social Security, their Social Security checks are larger because Social Security is a function of how much your earnings were when you were working. And so someone who retired in 2001, for instance, because of inflation or whatever, is going to have a lower Social Security check than someone who retires in 2021. And so it's sort of a double whammy there. And so this exemption is probably going to increase to beyond 6.5 million, I would assume, by the next report.
So just so, help me just stay on track here. I have a very basic question. Even though we heard a lot of fallout in terms of the charitable and the capital gains, you would think, like in the case of the capital gains, you would think we were raising people's taxes, but you're saying overall we reduced people's taxes?
No, so for when you capped the capital gains exclusion for the 40%, that would raise taxes for those people who had greater than $875,000 worth of capital gains in a given year. What I'm saying here is that, we still have this capital gains exclusion in effect. And so for anyone with capital gains in the state, though, that type of income is still receiving preferential treatment from the state. In fact, for anyone with less than $875,000 in gains in a given
Okay, so this is the cumulative status quo on capital gains, but the change we made, as you said, may have resulted in more taxes, less taxes to the state.
No, more revenue, because you limited the size of the exemption. That's what you did. And so had you not done anything, this orange block would be bigger, I think is what I would say.
Okay, I just need
Okay,
to wrap my head around it. Thank you.
Graham, I want to make sure you don't, we got a lot on the charitable tax credit. And the big concern was people wouldn't give. And I don't know if we have a number that, estimates how, what happened to charitable giving. Do we know that? Did it go down because we didn't pass on the charitable tax credit? And the same with the medical deduction. We were just passing on the full federal deduction, if my memory serves me. And we allowed it to be passed on, but only that above once you took out the personal deduction. And you mentioned, I think there was one other thing. So it cost us 4.29 in 2020, but what did it cost us in 2018?
Great
I
question.
mean, is that 4 point, are these numbers, what are these numbers in comparison to the numbers prior to our adjusting the tax code?
It's a great question. It's a really good question. So the medical deduction prior to changing the tax code in Vermont, it used to be just sort of a federal flow through. And that federal flow through cost us about $4 to $5 million. Now, it's kind of hard to compare apples to apples here, because back, 4 or 5 years ago, the amount of medical expenses being deducted is less than it is now. This is a deduction that at the federal level, they expect to grow, 10% per year, basically. And so it's difficult. So because you require that the standard deduction, the personal exemptions, be subtracted out of one's medical expenses, it's correct to say that our medical deduction is going to be smaller than nowadays than it would have been if we were just passing through the federal. So it's possible this number, if you didn't take out the standard deduction, you didn't take out the personal exemptions, will be closer to $6 to $8 million. I don't know the exact number, but that's sort of my professional guess. So that's more of the comparable number. So it was about 4 to 5, 3-4 years ago. It's probably, if you didn't take out the standard deduction, if you didn't take out the personal exemptions, and you allowed for the continuing care retirement communities to keep deducting, then it would probably be, 20 to 50% higher.
Yeah, because Social Security was a new exemption we put in. So that's what we lost. But the charitable tax credit, we used to just allow to flow through. And so this is, some of them we're losing less than we did before we made the adjustments, and some of them we're losing more. I just want to make sure we keep that in mind.
That's correct. So if your base of comparison is like tax year 2017 before you made all the changes, then the medical deduction is a little bit less costly now than it would have been. The charitable tax credit is a little bit less costly than it would have been otherwise. The charitable tax credit is slightly different in that it's a tax credit worth 5%. So it's worth more to basically any taxpayer with incomes less than $300,000 on average. And it's available to non-itemizers as well. So I think something like 90,000 taxpayers took the charitable tax credit in Vermont. And the number of itemizers in Vermont is not that high. So more people are benefiting from the tax credit, but the average is less, if that makes sense.
Okay. We can move.
And then just to wrap up the green bar here. So I would just say that the yellow and blue parts of this circle, I would expect to be growing, somewhat quickly going forward.
Can I ask a question before we leave this slide?
Yeah.
So I wanted to just check in on capital gains as they might apply to the sale of businesses. And the businesses I'm really thinking of over in Addison County in particular are farms. There are many farms that are, they're bigger. I mean, the biggest farm that I know that's for sale is for sale for $20 million. So they're not all that big, but so 875 is not that big a number in the world of farming. When there's, can you say a little bit about this? I mean, if there's intergenerational transfer, does that constitute a sale? I know there's, how do we address that kind of transfer?
Yeah. So remember, when we're talking about capital gains, we're talking about the gain, right? So if in the example of the $20 million farm, it's only the gain on that sale. So if they sell it for 20 million, but they bought it for 25, there's no capital gain there. So there's no tax applied. And so, in the case of farms, I know it's the farm, but it's also the livestock as well, is subject to capital gains taxes if you make money on the sale of those assets. And so I think the business part of that 40% exclusion applies to, when I say businesses, in farms and timber, we're only really talking about the gains. And what was the second part of your question again?
Well, I'm just thinking about, for instance, many farms are in, the parents or eventually become the grandparents, and then finally it's transferred on. So part of the challenge is that because they may have held it 30, 40 years, and we don't index for inflation, that farm that they bought at $100 an acre is now valued at $1,200 an acre. So I've never heard of anyone transferring a farm that actually hadn't appreciated in value in a significant way.
Yeah, so I think that raises sort of the estate tax questions. So I know there's our estate tax builds upon the federal, and there are exemptions for gifts, giving. And so to the extent that the farm is greater than value of, I think, 5 million now, then it might be subject to the estate tax. I would say on farms, I think we did a full review of the capital gains exclusion last report, and I can send that to Senator Bray, but the amount of the capital gains exclusion that goes to farms is very, very small. So of the 40% exclusion, I think, I'm trying to remember, I think it was less than 5% of it went to any individual with farm income. So it's a very, very small portion of the capital gains exclusion. And that might be a function of there's not very many farmers. Are claiming the exclusion, but B, the theory is that a lot of these, as you sort of hinted at, a lot of these farms, they don't have significant capital gains. It's not capital gains and income are sort of correlated. And so, and knowing the situation that we have, the difficult situation for farmers around the state and nationwide, it's just less likely that those farms are going to have huge increases in value over time. That's not to say that doesn't happen. The family farm, that was bought in 1920 for $1,000 is going to be worth more than that nowadays. But it's just the data that we see both in Vermont and nationally is that farms are a very small portion of capital gains and therefore a very small portion of the capital gains exclusion.
Thanks. If you could send that deeper dive from the prior year on capital gains, that'd be great. Thanks.
Okay. Chris and Michael, when you come back, can you lower your hands? Because I used to just be able to click on them and lower them.
I'm back. I will do that.
Okay, thank you.
Okay, so moving on. Here's the corporate tax expenditures. It's a not super interesting story. The key one here is the research and development tax credit, and that's for any expenses on research and development. It's about $1.4 million on the corporate income tax. And I think it's about that size on the personal income tax as well. But generally the corporate income tax, though it has, a number of tax credits available to it, is not, they are not claimed a lot.
Okay.
So moving on to the sales and use tax, a couple of new things, and this is building upon how we are trying to improve the report year after year. We had an intern this summer who we assigned to make better estimates for some of our sales and use tax exemptions, particularly some of the large ones. And the result of that was that we revised some of our biggest tax expenditures in the sales and use tax. So groceries in the 2019 report was $117 million in foregone revenue. After, diving into other states, what they estimated and changing the methodology, we reduced that to about $89 million this year. Same for the medical expenses, about $64 million at last report. And this year, we think it's about $54.8 million. And then the second thing that we did is because there are a lot of sales tax exemptions that are not estimated, one of the ones that we assigned our intern to look at was the estimate for sales by and from a 501c3 organization, because something like we estimate about 10% of the Vermont economy comes from nonprofits. And so we wanted to get a sense of that scale. And we estimate that that's about $15.4 million a year in foregone revenue by not charging sales tax to those kinds of people.
Yeah, Graham, so just to help me understand. So when UVMMC buys a computer printer, they must pay the sales tax and then we refund it to them?
It works. No, typically not that way. They have an exemption certificate with the Department of Taxes, and they show that exemption to the retailer.
Okay.
When they buy it, yeah.
But that's an example that accumulates to 15 million.
Exactly. Computers. I mean, it got confusing because we were thinking, well, for instance, with the hospitals, they buy a lot of stuff, but a lot of their stuff is exempt anyway through the medical exemption. So the durable medical equipment, that's already exempt. But for hospitals, it's things like computers or any other sort of types of supplies, building materials, stuff like that.
Thank you.
Okay.
So here's what that looks like. So sales of food, which is a fancy term for groceries, is $89.3 million. And energy purchases for a resident, or I think medical purchases, the next largest one, $54.8 million. That includes a whole slew of medical products. Generally, it's prescription, non-prescription drugs, durable medical equipment, and then any sort of medical product that provides therapeutic use. So like Band-Aids and things that help humans feel better. Energy purchases for residents, so any heating oil, propane, electricity, all exempt from the sales tax. Manufacturers and businesses are not exempt from the sales tax on their energy purchases. Clothing and footwear is $33.1 million. We'll talk about that this afternoon because we did a review on that one. And then agricultural inputs, well, is $16.9 million. And then all other expenditures are about 34 million. So, and that gray box, light gray box is, or triangle rather, is made up of many sort of smaller exemptions. So like the, $1 million here, like veterinary supplies is about $2 million. Trying to think, like museums is about 2.5 million. The entrance fees for museums is another 2 million. Coin operated laundry facilities, another 1 million. So sort of adds up to about 34. Any questions
Okay.
on sales and use?
Any questions? I can see 3 of you. I'm not hearing any. Okay. Keep going.
And I just want to point out also, I made the distinction when I presented this in Ways and Means that these are our estimates for what we think is the foregone revenue from these tax types. So for the sales and use and across all others. But that does not necessarily mean that if we repealed the tax, this is how much money we would collect. There's sort of a difference there. So for instance, if we repealed the clothing and footwear exemption, I'm not saying that we would gain $33.1 million, because what might happen is you might see some cross-border shopping happening, for instance. And so the revenue estimate from that might not be $33.1 million. And so that applies to many exemptions and tax expenditures here. Just to make that distinction.
Or people might change their buying habits.
Exactly, right. So yeah, I think I told the Ways and Means Committee that in the event that the committee wanted to address some of these, we do sort of a deeper dive into these. A good example of that was the veterinary supplies exemption. I know this committee spent a lot of time on that veterinary supplies exemption a couple of years ago. And in the tax expenditure report, that exemption a couple of years ago was about $4.2 million. But once we started diving into the data further and figuring out what was current practice and when it looked like the exemption might be repealed, then we came up with a different number of about 2.5 million. So that sort of difference is what I'm talking about here, is if you repealed it, that's a different number than what we think it's costing by not collecting it right now.
Okay.
So moving along to the meals and rooms and the meals tax and the rooms tax, a lot of these are not estimated. And that's just because we just don't have good data on some of these things, and it would just be so inaccurate to estimate them that it would not be helpful for the legislature. And this is something that we're trying to do at JFO is look at some of these and just take another glance to see if we can, especially if we think they're large, making an attempt at it. So the biggest one in the meals tax is the grocery type items furnished for takeout. And this is one of these areas where I don't envy legislators, but what this means is essentially if you're buying things like cakes or less than 3 bagels at the grocery store or pies, that is technically a prepared food, but it is for takeout, but it is not subject to the meals and rooms tax.
If you buy a bag of potato chips to eat with your sandwich, it's taxable. If you buy it to take it home, it's not, was one exemption. It was pointed out to me.
Precisely. I mean, this is a sort of squishy exemption, and it's difficult to estimate and apply. But the tax policy reason, I think, is there. Things like the hot bar at the grocery store, that's a prepared meal, and that plays the meals and rooms tax. But how different is that from a pie or a cake or something like that? There are various tax department rules around this. And as I mentioned in Ways and Means, that a lot of these exemptions are in statute, and the statute lays out some examples there, but then the tax department sort of puts meat on the bones on what exactly this means. That's typically how tax policy works. And there's still, issues and situations where it's not exactly clear, but that's where the tax department comes in and makes rulings on these things.
Maz's challenge was ice. Is ice food? You put it in a drink, or you might put it in a cooler. I believe the last tax commissioner told us ice was taxable.
Wouldn't surprise me. That would be my guess.
Crushing.
Yes.
Senator Cummings, you're giving me these almost traumatic flashbacks to break open tickets.
Oh, don't even say break open tickets. We've had some trauma in this committee. Senator McDonald, did you have a question?
No, it was just a pun. Keep going.
Oh, okay. And there was a present rep, I believe, former lobbyist for the grocers who used to talk about, I don't know if they baked it across the street, but anyway, he brought us a lot of really good baked goods to demonstrate his issue.
Not all bad being a legislator. We'll just baked goods.
Yeah, except the liquor control people never bring samples.
Well, what are you gonna do?
Okay, we can keep going.
Under the rooms tax, the two I want to highlight that I think we'll probably take a look at next report is the exemption for rooms at continuing care retirement facility and hospital, convalescent, and nursing home facilities. That one, I think could plausibly be quite large. But the issue is just the pricing mechanisms that these two entities charge for a room is typically not delineated in their pricing schemes, and so it's difficult to estimate. You might get a hospital bill, but isn't necessarily delineated as here's how much it was to stay here for 2 days. Or not to say that there's any chance of that being repealed, but just it is something that is in the statute, and I think could be a quite large number once we estimate it. So we'll
How about
probably
independent living?
I don't know whether that fits under some of these. So a lot of
Madam Chair, I will withdraw the question. We'll certainly have a discussion of this later.
Oh, yeah.
Could I ask a
Okay.
question?
Yes. Senator Hardy, I can't see you, so.
Okay. Graham, is the hospitals and nursing homes and all that, wouldn't those, are the room costs distinct from medical costs in terms of the exemption? They count under the exemption for rooms tax rather than the medical exemption?
So it's a different tax, right? So the sales tax on medical products does not apply to medical products, but a room itself is not a product. And so when I looked around a little bit at this to see if we could, make an estimate this year, a hospital bill do not in some cases, or in the ones that I saw, do not list out the cost of the staying in the room itself. It's sort of a general a charge, but then furthermore, the pricing is difficult, right? So hospitals maintain certain prices for the services that they provide, including the cost of staying a night in one of the rooms there or the beds, but that's not necessarily what the taxpayer or the person is paying. So it is somewhat difficult to delineate those types of things.
What about medical services? Like if you're in the hospital you get a service, some kind of medical procedure, there's the service, there's the products, and then there's the room.
Right.
The products are not, they're tax exempt. The room is tax exempt. What about the service?
Service is, it's not part of any tax base because it's a service. So it's not an exemption. Okay. It's just a service that is not part of the sales tax base. So it's not listed as an exemption. It's not considered an exemption. It's just not part of the tax base.
Got it. Okay. Thank you.
These are good distinguishing examples there.
And I do remember discussion about meals, hospital cafeterias, some of which are now being run by national restaurant chains. And this brings up other traumatic committee meetings, trying to get an exact breakdown of what something costs from a hospital. To date, we have not been very successful. So, yeah. All right.
Then I'll switch over to the property tax expenditures. So unlike the other tax expenditures, total property tax expenditures are about 95 million, and it's many sort of largest chunks, rather than just like one or two that are very large and then many that are sort of smaller, but many exemptions that are smaller dollars. The property tax expenditures, about 60-ish, 65 million of the 95 is what we call the public, pious, and charitable exemptions. And I want to flag for the committee that the property tax expenditures, these are the tax department's best estimates, but because some of these things just have not been taxable for, since the age of time, it's unclear whether the data on these is as good as you would expect for a normal property, because you might have appraisers in towns who are just sort of saying, oh, keeping an up-to-date appraisal on the local hospital is not necessarily that important because it's never been taxable. So
try the property of the state of Vermont in Montpelier.
Exactly. Same sort of issues. But, with that caveat in mind, the state colleges and UVM are about a $19.7 million tax expenditure. Charitable organizations, which include a huge slew of types of organizations, from healthcare organizations to community centers to Grange halls to I'm trying to think of other arts and recreation. So like the Flynn would fall into that one. So it's 6.7 million. The private colleges, so Middlebury and Norwich are almost 95% of this $18.6 million tax expenditure. Pious organizations, churches, seminaries, convents, another 13.2. Private and public schools are 16.7. I originally thought this was just the independent schools, so like St. Johnsbury Academy, Burn Burton, but it also includes some local schools. I'm looking at the data. We did a deep-ish dive on this, an expedited review on the public, pious, and charitable. We sort of looked at the data, and there are some what I would consider just local schools that are not independents in this exemption, which is a little bit odd. But 6.7 million. And then hospitals are $15 million tax expenditure. TIF districts, another almost 6 million.
Senator Bray, you have a question.
Yes, please. Thank you. So I can understand how appraisals might be vague when something's never been taxed. But can you say something a little bit about payment in lieu of taxes? I don't know which of these slices of the pie end up doing pilot payments, but I'm wondering how they figure out what those payments should be if there's not a very good appraisal or not a very good sense of what the tax foregone was valued at.
Yeah, so I would say a couple things. I think you're right that the appraisal is difficult in these cases. But remember, this is just the state education property tax rate. So property tax payment. So I'm just thinking about the private colleges. Middlebury College, I don't believe, provides a pilot to the state. They have, I think, pilots with the town of Middlebury. But this is the state education. So it's not as if you would offset the pilot cost of these. In any rate, I think for most of these entities, the pilot that they are paying is quite a bit smaller than the municipal tax, and it would certainly be quite a lot smaller than their state tax. But again, I don't think any of these entities are paying state pilots. The biggest pilot I'm aware of is the pilot fund for the city of Montpelier and state government buildings that the state, has established a pilot fund using local option taxes, and they give money back to the municipalities for hosting state property. But again, I think that the pilot agreements between municipalities and towns are kind of negotiated amongst them, and I don't know exactly how they come up with the numbers on those.
Yeah, I'll just jump in a little bit because this is an issue every year pretty much at the Middlebury town meeting. This comes up. you're right that colleges, at least Middlebury, does not pay a state property tax pilot. And the one for the town is just negotiated, and it's much lower than what the property tax would be had they, were they paying it. But they do pay property taxes on their residence halls. And is that state law, or is that just something that's part of their negotiation, Graham? Do colleges and universities have to pay on their residence halls because they're considered residential? Or is that just a unique thing that Middlebury does?
I don't know the answer to that question. I'm not necessarily as well versed in property taxes as other people in my office, but I'll follow up with that. All I know is when I was doing the review for this, I just know that there's an estimate for the exemption for Middlebury and for Norwich and for other private colleges.
And it is quite large, and it is contentious because they don't pay the education property tax at all. There's no pilot payment for it.
Graham, these costs are only state costs, right?
Yes.
But unlike the exemptions are state exemptions. These are categories the state has said do not pay property tax, but there's not an equal, but there is an impact on the local property taxes because you can't tax them. And for some towns, it's extensive. That's, the brouhaha has settled down, but having worked on a state pilot program for a number of years, the cost to some communities of having large amounts of state declared non-taxables, but the communities are expected to provide funds for services. Montpelier has 8,000 people, but 20,000 come in here every day, mostly to the state. And Montpelier provides fire, police, ambulance, and other services, including to state buildings. So that's gone away because of the pilot that has been negotiated. But this is a tax exemption that also impacts the local revenues and local expenses, and those with large tax exempts, mostly your small cities, your cities. If you have a state forest, you get property tax rebates for it from the state, but not one of these exempt unless you negotiate a pilot. So this is kind of it's more complex than that. Senator Bray.
Yeah, I know that maybe Senator Hardy knows a more current number, but the last time I saw figures for property owned by Middlebury College in the town of Middlebury, it was 37% of the real estate. So it's a very large footprint. And, that agitates some people for foregone revenues. Meanwhile, though, they're the largest economic engine for the county. And so, there's a lot of value that doesn't show up on that property tax piece, though, that nets out in, the college would say in a very positive way. So I don't want to be only talking about one side of the scale and make it sound like I'm disparaging their contribution or something.
No, it is a two-edged sword. I think the city of Montpelier is experiencing what happens when state employees are not in the city. They aren't eating lunch, they aren't shopping, and the downtown businesses are feeling that pain for all of these. But the state does tax the rooms, the meals, and the income generated. The towns don't. So this is a perpetual argument, and it tends to your position tends to be on which kind of community you come from. So we'll go on, but this one isn't just the state foregone revenue.
I'm sort of conscious of the time here, so I'll sort of pick up the pace a little bit. Here are the tax exemptions or expenditures for the bank franchise and the insurance premiums tax. Just for a quick overview for the committee, the bank franchise tax, I think, is the tax of 0.009, or there might be another zero in there, 0.0096% of average monthly deposits for a bank that has deposits in the state. And the insurance premiums tax, I think, is 2% of premiums written. And so the big ones on the bank franchise tax are the credit unions. So they do not have to pay tax on their deposits. The affordable housing tax credit and the downtown tax credits, and this is something that I'll talk about when I talk about the review. The way that works is that, you can claim those credits on your personal income tax. But what a lot of entities do is they will sell those credits to banks, and the banks will provide them with capital, and then the banks will declare the tax credits or use the tax credits on their tax liability. And then on the insurance premiums tax, the two big ones are annuity considerations. So any annuities that are sold in the state of Vermont are not subject to taxation. And that's a really complicated subject that the legislature has reviewed many times. But it has something to do with what are called reciprocity agreements. So if you were to tax annuity considerations, then any annuity sold in the state of Vermont would become taxable. But lots of other states have these trigger clauses where any annuity sold by a Vermont company that sells annuities would then have to pay taxes on those. And so this hurts a major annuity seller in the state if you got rid of the exemption. But most of the revenue would come from annuities sold by out-of-state corporations. And then the hospital medical service organizations, that's essentially the insurance premiums written by Blue Cross Blue Shield Vermont. So your health insurance premiums are not subject to the insurance premiums tax. And then wrapping up with the motor vehicle tax exemption. So the diesel fuel, I apologize for an error here in the chart. The totals line for the gasoline and diesel fuel, the only tax exemption that amounts to anything in those two taxes is the off-road exemption for farm vehicles for diesel fuel. It's about $131,000. And then on the motor vehicle purchase and use tax, the two big ones, gifts exemption. So if you're giving a car to a family member, it's exempt from paying motor vehicle purchase and use tax. And then the trade-in allowance. So technically, when you're trading in a car, you're selling your car to the dealer, and the dealer would pay purchase and use tax, or you would pay purchase and use tax on that. But because we have the trade-in allowance, it is in effect an exemption from the purchase and use tax, and that costs about $35 million a year. And so basically, amongst the motor vehicle purchase and use tax, gifts and the trade-in allowance account for basically everything. And that's it.
Okay, committee, any questions at this point? If not,
Wait, just one quick,
okay.
I'm sorry, Graham, I see the full report is online on our website, but can you provide us your slides too? Because they're just easier to follow.
Absolutely. Yeah.
Okay, I'm going to give you we're almost, it's 2:45, so 15-minute break. We're about a half hour behind, but I think when we get into the depth, we'll have more questions when we get into the deeper dive on these two sections. So, Faith, I got a chat pop up that said she's back. So if you turn off your video and your audio, I think we can get up yep. And then I'll see you at 3:00.
Mike. Senator Sorokin.
Hello, Senator McDonald.
Hey, I got I got shut out of the floor today. Had to reboot the a couple devices to get back on again. But did they take up that appropriations bill?
They did, and they passed it with the amendment to add the,
The several items?
yeah, I wrote you on a couple of things after the hearing.
Senators, I just want you to be aware that you are still live streaming on YouTube.
Oh.
Yep, that's fine.
Okay, just wanted you to know.
Thank
No,
you.
but thank you very much. Thank you very much, Dave. So we sat in yesterday with appropriations when they were discussing that issue, and it did come up for action and it did pass.
The issue of the broadband subsidy, or?
There were several items.
Yeah, those
Yeah, broadband subsidy,
the extension of the connectivity for works that were in progress that had suffered through.
and did it include extension of monies to fill the rent
Yeah.
applications that hadn't been, that
Yes,
ran out of money in December,
yes, all of that.
based on for the previous federal
Right. Plus they put
act, not for the one that is yet to come out. Yeah, okay.
$10 million for the one that has yet to come out to get it up and running and started, and to cover the first couple of months, because the last pot of money was only authorized through December 31st.
Okay. Voice vote, roll call.
Voice vote.
Thank you. Thanks for bringing me up to date.
Yeah.
Sometimes this Zoom business
I
locks you out.
actually tried to reach you yesterday. I don't know whether it's text or emails on the broadband subsidy, the $40 a month extension. Do
You don't mean, when you say extension, you're not talking about wires, you're talking about.
No, I'm talking about the subsidy. Sorry, the $40 a month help pay your internet bill for people who are in need and have telemedicine and educational and remote work needs. That program ended in December, and there's a new program coming in March. So we wanted to have a bridge funding to keep the program going for 3,000 households. And the Appropriations Committee agreed to that. And it cost about $270,000.
Yeah. Well, good. And that was limited and timely to COVID issues. And
Right.
Yeah.
Right.
So,
I'm gonna,
Got 2 whole minutes. Okay, my clock is fast.
2 minutes before we go on?
2 minutes before prime. Yep. For showtime.
Senator Sorokin was catching me up on what I missed on the floor. Thank you.
I and everyone who is still tuned in can hear you, Senator.
There's nothing that I asked and that he answered that
I didn't
wouldn't
think
want to
it
have
was.
any that I would wish to conceal from anyone.
I did not feel any inclination to bound across the room and remind you before Faith reminded you.
Right.
No, Faith, we thank Faith because she was right on the ball on that one, as she always is.
Except that she's, yeah, okay. My clock says 3 o'clock, so whoever's there, you want to put back your video, and as soon as we get Graham, we'll get back to work. Okay, now we're going to do a deeper dive.
Indeed. Let me just start this from the beginning. I'm assuming that the committee wants to begin with the downtown tax credit review, because that's the one that was, it was a pretty deep dive, and it was one of the ones scheduled to be done according to statute in 2020.
Probably one that will come up again this year.
Right. So just a little background quickly, the Act 134 2016 sort of laid out the schedule for these reviews, and it sort of laid out the concept of expedited and full reviews of tax expenditures. An expedited review typically is like 1 to 2 pages, and it's an overview about who gets the credit or the exemption of the tax expenditure, and then other considerations, some statutory history, and then some minor recommendations, if any. A full review is a much deeper dive into these. And so we started doing this 2 years ago. And the first one that we ever did was the capital gains exclusion. And this is the second year that we've done these. And this one with the Downtown and Village Center Tax Credit Program was chosen because it's the largest of the tax credits that fits in this group of housing and community development tax credits. And it's something that has been subject to legislative changes almost every year since 2007. So it seemed reasonable to look at this program. So before I get going here, I want to just thank Chris Cochran and Caitlin Corkins, who work at the Department of Housing and Community Development within the Agency of Commerce and Community Development for all their help on this. This was an enjoyable review to do because of the data that they made available and the cooperation I had from them. It's sort of a model situation between legislative and administration on the reviews. And I know colleagues in other states that do reviews, and they oftentimes get pushback from their agencies. So it's a privilege to be able to work in such a cooperative manner with the administration on this. So with that, I will dive in here. So the Downtown and Village Center Tax Credit Program was officially created in 1999, but it was significantly changed in 2007. And prior to 2007, it was largely quite a small program that was really only given to those projects that did not receive the federal historic rehabilitation tax credit. But the sort of modern program that I'll be talking about here came into effect, and the more sort of recognizable program came into effect in 2007. And when we talk about the Downtown and Village Tax Credit Program, we're really talking about 3 separate tax credits, and they're all used to assist individuals and developers to rehabilitate and modernize older and historic buildings in downtown areas. The key thing in Vermont's program. But so it's 3 credits: the Code Improvement Credit, the Historic Rehabilitation Credit, and the Facade Improvement Credit. And again, I said it's only for structures that are in designated downtown and village centers only. So this is a designation given by the Downtown Development Board, I believe. So if you don't have that designation, you're not eligible for these tax credits. And they are capped by statute at $3 million per year. And some of those, so every year the board will issue up to $3 million in tax credits. Some of those won't show up on our tax in our tax expenditure report because a lot of times credits are carried forward for up to 9 tax years, or sometimes they're recaptured if the project doesn't happen within 3 years of approval. So some years you might see more than the statutory cap get awarded because of the recapture, and then on the tax expenditure report, you might not see $3 million worth of claims every single year because of the carry forward effect. So the details of the three specific credits, the first is the code improvement credit, and it is a 50% credit for qualified code improvements with certain maximums depending upon the type of code improvement that you're doing. So it's $12,000 for an installation of a platform lift, $60,000 for a limited use, limited application. Apparently, I didn't know this is called a Lula elevator. $75,000 for an installation of an elevator, $50,000 for a sprinkler system, and then $50,000 for the combined cost of any other code improvement. There used to be a technology credit sort of associated with this, but then it's since been repealed. The second one is the historic rehabilitation tax credit, and that's a 10% tax credit for the qualified rehabilitation expenses as defined by the federal historic rehabilitation credit. So there's the state historic rehabilitation tax credit, which is 10% of the expenses incurred for a rehabilitation of a historic building. And the definition for what is defined as expenses for rehabilitation is defined from the federal historic rehabilitation credit, which is 20% credit for any expenses on your federal taxes. But the restrictions on those are a little bit, are determined by the Internal Revenue Code. But generally, those expenses are related to improving the structure of the building. So, the facade, the plumbing, the wall, stuff like that. And in order to be eligible for the federal rehabilitation tax credit, your building has to be listed on the National Registers of Historic Places. And then finally, the facade improvement tax credit is a 25% credit for the qualified facade improvements, and you can only receive up to $25,000 for a facade improvement. And what is a facade improvement? It's an improvement to the building that, quote, this is from statute, contributes to the integrity of the designated downtown or designated village center. The table 1 here essentially lays out since 2005, the percentage of credits that have been given to the various credit downtown programs. So the code improvement credit accounts for about 60% of total credits issued. The facade improvement is about 6.79 million, so about a quarter of the total. And then the historic rehabilitation credits, about 4.58, about 17%. And you can see under the code improvement credits which ones went to certain things. So about a quarter, a little bit over a quarter of the total code improvement credits were for other code improvements. And then about 17% went to sprinkler systems installations. So,
Graham, is that a total for that whole 15-year window or per year?
No, that's a 15-year window. Okay, so.
Oops, am I on? Can you hear me?
Yep.
I can hear you. I can't see you, Michael.
Okay.
So go.
Well, I'll get back on the visual.
No, you're just blocked off of mine with the.
No, I'm sorry. So how does this? Oh, these are the credits you say are basically just sold to banks, and they take them as reduction in their income.
Yeah, so you essentially have 3 options for your use. If you're awarded a downtown tax credit, if you're awarded a code improvement, a facade improvement, or a historic rehabilitation credit, you can claim it against your personal income tax. You can claim it against your corporate income tax, your corporate entity, or you can sell the tax credits to a bank or an insurance company who will give you essentially up cash for those tax credits. And those banks or insurance companies take the tax credit against, if it's a bank, their bank franchise tax, or if it's an insurance company, it's the insurance premiums tax. There's not a whole lot of history of insurance companies buying these, so it's mostly banks. And it's my understanding after talking to various stakeholders here that generally you get about anywhere between 85 and 95 cents on the dollar for the value of the tax credit by selling it to a bank. And it's advantageous that way because a lot of the developers and the people who receive these tax credits don't have the tax liability to essentially make up the cost of the credit. So either you carry it forward for 9 tax years or you sell it to a bank. And so that's one of the advantages of the programs. It's very flexible for the individual who receives or the developer or company. It's very flexible for them to access this money and use it for code improvements. And as a result, what you see is the credits are awarded and they're almost used immediately. It's quite quick, and that's one of the reasons why it's oversubscribed every year. But that's something I'll get into.
That's, the developer can sell it to anybody. It doesn't have to be a bank. It could sell it to an individual.
A good question. I don't know whether they can be transferred to another individual, but I know that most of the time they're sold to banks for upfront.
Graham, I believe it can, originally it was banks. I remember when we added insurance companies. I think that's the limit, but double check that.
Yeah, you can sell them to insurance companies, but I'm wondering whether if you're an individual, can you sell it to another individual?
That,
No.
I don't think so, but double check that.
Yes.
Graham,
Yes.
I'm sorry, I'm not sure if the chair can.
I can't see you either, Senator Hardy, so.
Okay, just quickly, I've never heard of this before. I'm new to this area, but are there other types of tax credits that you can sell to somebody else, or is this the only area?
The affordable housing tax credit is another big one that is claimed by, usually it's claimed by nonprofit entities, affordable housing builders, and they don't have tax liabilities. What they do is they sell it to banks to access the capital for their project. So yes, this does exist, but other tax credits, no, you can't sell your research and development tax credit to a bank if you don't have the tax liability. So
Okay, so it's mostly with like development or housing or the things that have mortgages or whatever. That
for projects, yeah. I mean, the only ones I can really think of off the top of my head are these ones, the downtown tax credits and the affordable and charitable housing tax credits are the other ones that you can sell to banks.
Thank you.
Yep.
Was a movie tax credit that would have been transferable. That didn't get passed.
Transferability in tax credits is usually one of those things in the tax world that's considered a way to really make your tax credits balloon in cost. But in this case, it's a good, I think it operates in a good way because it just allows people to access the credits that they're being awarded. Yeah, and generally they get good returns on those. So, it's not an efficiency issue, I don't think. It's not like the banks are profiting a ton on the use of these tax credits or by buying them. So there's quite a lot of statutory history to the downtown tax credits program. I'm going to kind of skim it in the interest of time to get to more of the actual meat of the analysis. But as I mentioned, there was a precursor program to this downtown tax credit, which was established in 1997 by Act 120. And essentially it was 2 tax credits for the rehabilitation of historic buildings. I can't quite remember off the top of my head what exactly those were, but they were quite a bit different than the modern program we think of. But the modern program we think of in the downtown tax credits with the 3 separate credits, the code, the historic rehabilitation, and the facade improvement was established in Act 183 of 2005. And it was established with a $1.5 million cap. And that was created at the same time as, I can't remember exactly the statutory, it's 24, it's essentially the statute about municipal or downtown and village center designation. So this was at the same time that Vermont really made a decision to invest in its downtowns and create incentives for developers and people to build within downtowns and for towns to take a more holistic approach to their development. And so since 2007, when the actual modern program went into effect, there's been lots of various definitional changes to the program. For instance, what type of building qualifies for this, or I mentioned that the code improvement credit, it contained for several years a technological improvement credit within it with a cap, and that has since been repealed. But what has definitely changed almost every year is that the cap has been increased by a couple $1,000s here and there almost every year since 2007. So started off at $1.5 million. It is now at $3 million, and that was just increased last year. And a lot of that increase is due to the fact that these credits are oversubscribed every year by people applying for them. So the statutory purpose of these credits is the same for all three of the credits. So it's to provide incentives and improve and rehabilitate historic properties in designated downtowns and village centers. That's the Title 32 statutory purpose of the tax credit statutory purpose. We looked a little deeper beyond that because that's a relatively vague statutory purpose. We looked at, this is the statute with the downtown designation, this 24 VSA 2790. It provides sort of the goals for downtown and village center designation as a whole. And so this program is very much linked to that designation. It's an incentive for towns to get designation. And so that statute, that part of statute has separate goals. So like supporting downtowns by providing funding, training, resources to increase economic growth and diversity, attracting new existing residents to downtown, removing barriers for collaboration between downtown organizations, developers, businesses, and encouraging mixed-use development downtown. So when we were evaluating this tax expenditure against the statutory purpose, it wasn't just against the Title 32, it was against the 24 VSA 2790 sort of goals that were laid out in the designated downtown area of statute. Because we think that was more of a holistic approach to laying out what we thought the goals of the tax expenditure were. And that's what Chris Cochran sort of guided us to. That's what the board is sort of looking for when they review applications for these. So our main findings on this review are broken out into what we call operational findings, the fiscal findings, and the economic impact findings. So I'll begin with the operational. And by and large, we think the Downtown and Village Center Tax Program, Downtown and Village Center Tax Credit Program is doing a pretty good job of achieving its statutory purpose. So it simply and effectively channels public funds into projects. And the projects that it does fund are those that tend to improve and revitalize Vermont's historic centers. And then those projects are generally in the areas of the state with the greatest economic development needs. So it's done a good job at making these easy to access, easy for developers to convert into capital. It's been sending them to projects that are more transformative for a community, and they've been sending dollars to areas of the state that have the greatest economic development needs. Figure 1 here essentially shows the amount of tax credits awarded since 2007. It's gone from roughly 1.5 million up to around 3 million. You can see that red line is the program cap. The reason why the blue bars can exceed the program cap is because of the recapturing of credits. So if projects don't happen within 3 years, it actually used to be 5 years, but because the program has such high demand, one of the recent statutory changes was that was made to a 3-year limit, sort of get money out the door quicker. And generally, the average credits per year have fluctuated over time. They were quite low in sort of the wake of Hurricane Irene, but they've sort of been increasing year over year since then. So the average credit right now is about just over $110,000 per claimant. So within this operational finding, the first thing we found is that we thought that the tax credits were successful at targeting what we call shovel-ready projects with a wider potential economic development purpose. So when I say shovel-ready, is that we're issuing credits and they're basically being claimed or used immediately. So in the data set that I was given from the Department of Housing and Community Development, there were 226 projects that were awarded credits, and only 35 of them were subject to recapture. And so that's a pretty good success rate. You're essentially getting the money out the door. It's being used quickly and effectively. So that's very much a good thing. And the projects that were being chosen this is more of a qualitative assessment, seem to be those that were chosen more that had the potential for wider economic development or wider economic benefits than those that had mostly private benefits. So I give the example in the report. Things that have been improved over time are, very large developments that revitalize a downtown city block. So like the Brooks House in Brattleboro, the Putnam Block in Bennington is another. Or even smaller things. So the revitalization of the Willie's store in Greensboro. It's sort of it's a store in the little village center there. That's sort of a community gathering place. The Craftsbury Public House is a restaurant in Craftsbury. It's sort of a meeting place. And so those were being improved rather than more private things. So applications that I saw that were being rejected were the renovation of a 2-bedroom bed and breakfast in Stowe. It wasn't clear what the renovation of a restaurant in downtown Virgins, in a place that has multiple restaurants. It's not exactly as clear cut what the overall community development aspect to that is. And so we thought that the board was doing a good job at sort of targeting those that had a wider economic benefit as defined in Title 24.
Madam Chair?
Yes, Senator McDonald.
As you know, I'm wary about tax credits, and I've always supported the downtown tax credits. For years, we are told that many of our downtowns, the second and third floors, have been rendered unusable because they don't have proper stairways and railings and fire retardant sprinklers. And they'll just sit there unused. And this has been a good program to get those places used. It's enough. It raises an eyebrow when we find that money is not being used for those purposes for dealing with facades. Is this just one of those natural incremental growths of things that started for one purpose and have gradually flowed into other purposes?
I think Chris Cochran could speak to, how that works, but I would say that, the facade improvement credit is, it can be integral to the functioning of the building. I'm thinking about an example of a building in Bethel that took the facade improvement credit, where the credit was used to repair, a lot of the very old brickwork that was deteriorating around the building. And so it was almost a structural type of thing. And they used the facade improvement credit there. And so it's not just used to pretty up the outside of buildings. I think there are many cases where the facade improvement credit
Thank you, Graham. I had misread the term facade to mean decorative something or others and not restoring the brickwork, whatever. Maybe perhaps I apologize for making that mistake. Thank you.
But this is an historic, sometimes replacing shutters, cornices on the top of buildings can be very expensive. But I think, Senator, a fair amount of the second story renovation may be going under the affordable housing tax credit, because that's frequently where we target.
It's to keep bricks from falling down on people and not to do Art Deco stuff.
I don't think it's that. I'm trying. Another example is I can't remember if it received a tax credit, but there's the building on the corner of State Street and Bailey in Montpelier that, its paint was chipping everywhere and it required repainting. That's a facade improvement project, I believe.
Yeah.
So it is integral to the functioning and the value of the building.
Madam Chair.
He has a question. Yes.
Thank you. Just a quick question. You referred to a board, Graham. What board is it that oversees this program?
It's the Downtown Development Board. they receive all the applications, and they're the ones that make the determination who gets the credits.
Okay, thanks.
So the second part of the operational aspect that we found is that the program funds a very diverse range of projects that all meet the statutory purpose. And this is one of the things that the themes that I came up with doing this, is that the program is almost really two separate programs. You have a program that funds very, very small projects. So out of the 335 projects that have been approved since 2007, 99 had total project costs of less than $200,000. So we're talking very relatively small upgrades, you know, putting a sprinkler system into a building, or building a wheelchair ramp, you know, relatively small things. But then there are these significant, very large projects receiving the exact same credit. So 50 of the 335 projects had total project costs greater than $2 million. So I use the example talking to various people that you have, you know, the Victorian with 3 rental properties in it, and it applies for a downtown tax credit to redo its sprinkler system. That's approved. It has obvious positive impact on a downtown. But then you also have something like the Putnam Block in downtown Bennington, which receives downtown tax credits, and that's a community downtown total game changer for the community. So in evaluating this program, it's almost somewhat difficult to sort of make broad or generalizations about whether it's working or not, because it's like almost 2 different credits. So that's what this table 3 is showing, is you see the amount of projects here that have not been recaptured. So about $27.2 million worth of projects. About 10 million of it goes to projects that had total project costs of greater than 3 million. About 5.7 million went to projects between 1.1 and 3 million. But you see there's a significant number of projects that are awarded tax credits, you know, and so you have this almost just these 2 programs to operate in one. But all of these credits are generally used in a way that promotes economic activity and quality life in downtown. So the data set that I received lists out the type of projects that are being built. So 66% of them were awarded to projects that have some sort of retail or commercial purpose. So you know, redoing a store, or it might have a restaurant, or it might have something else in it. 44% of the projects stated an intention to either add or improve housing in the downtown area, which is a very has been highlighted as a need for years in the legislature. So all of these things are generally chosen by the board. They all have a sort of positive community aspect, community vitality aspect to them. So they go to a wide range of projects, small and large, and then commercial housing, arts and recreation, things like that. The next operational finding is that we found that the tax credits the board has done a very good job of awarding tax credits to areas of the state with slower economic growth. So 65% of the total credits have been awarded to projects in municipalities located in counties with below average GDP growth. So table 2 here shows essentially that the towns that have received the most tax credits from the Downtown Development Board and the total number of projects. And then it shows the county's real GDP growth from 2001 to 2018. The Vermont average is about 25%. So total Vermont GDP has grown 25% over that period. But you see in some counties, it's much less. So in Bennington, the total GDP growth in that county is 3% over that time period. And so you can see that Bennington's received quite a lot of downtown tax credits. So you see these slower economic growth areas receiving quite a lot of tax credits. And I compare that to the tax increment financing program, where only 8% of the total dollars have gone to municipalities with slower than average, economic growth. So it's done a very good job, even though, Burlington, Winooski, St. Albans, they do receive tax credits. The majority of the dollars here are going to areas of the state where there's economic development needs. When I spoke to developers about the tax credits, one of the things they told me, though, is that it's tough to get credits to places where economic growth is really depressed. So a lot of areas in the Northeast Kingdom, because there needs to be some sort of latent economic pressure to build. So it's not simply the credits that are driving the economic growth here. There needs to be some community involvement and some sort of potential here. And that's why you see places like Brattleboro getting a lot of downtown tax credits, because it's not necessarily the slowest economic growth area of the state, but it is slower, but there is, movement from the town and economic sort of latent growth that is driving the sort of need. So essentially the ball won't get, the downtown tax credits don't drive the development completely. You need a little bit of underlying growth here. Looking at who claims the credits on personal income tax, it does not look like as though the credits are only going to high income taxpayers. So I think it was something around half of the credits issued and claimed since 2000, I think it was 13 or 14, went to taxpayers with incomes above 150,000. So you have quite a lot of people who are claiming these credits with not very high adjusted grosses, not very high, but middle income taxpayers. Again, it's difficult to know who the benefit for the banks is really benefiting, because most of these credits are claimed on the bank franchise tax, but the ones who do claim it on their personal income taxes are not exclusively high income. And then I've touched on this before, but the simplicity of the program allows for a wide range of taxpayers to use them. So the credits can be sold to banks for upfront financing, and they can also be carried forward for 9 tax years. So if you receive one of these, there's a good chance that you're going to get the full or very close to the full value of the credit, and in a relatively easy way. And we think this is the reason why the program's been oversubscribed every year since 2007, and why the agency comes back and asks for increases in the cap. So moving on to our assessment of the economic impacts. This is not something that's in the statutory purpose. So it's not saying that the program has to generate significant economic impacts, but we wanted to look at it because we think that's an important part of the program and part of the statutory purpose somewhat in Title 24. But we found that the economic impacts of the program were likely positive in aggregate, but they vary significantly depending upon the unique circumstances of each project. And in some cases, they might be offset a little bit by the credits. And so we approached this from 3 different areas. We looked at the literature on various historic tax credits. We did an analysis of whether these projects would have occurred if not for the use of the credits. And then we looked at the discussion of the scope of economic impacts by project. So on the first, generally the economic literature on historic tax credits has found positive, wider economic impacts. But I think the caveats we would put on this analysis is that many of these studies that we looked at essentially just take the credits as an input to the analysis and then, generate multipliers in employment and construction benefits, stuff like that. It does not take into effect, did these places really need the credits? And then they're based upon actual just industry multipliers from the federal government. So the federal government produces what they call multipliers on jobs and things like that. And so for any given project, these studies will just take those general multipliers and use them on the analysis rather than looking at the actual data here. I see Senator Brock has his hand raised.
I do. I just have a brief question. We've had a lot of comment from the state auditor's office questioning the value of many economic stimulus programs, such as the TIP program and other similar activities. Do you know if the auditor's office has looked at these tax credit programs with respect to claimed economic impact?
I don't think they have. I sent them this review for their comments, so they have seen this report and had input in it. But their office
no comment back one way or the other.
I think they had some valuable comments about various things associated with the but-for on that. But as with every other commenter on these reports, some things we take, some things we don't. We like the input from various parties. So the state auditor's office was a reviewer on this, but their office has not done an analysis on the actual benefits of
Okay,
tax credit programs.
thank you.
One study I wanted to highlight was the Iowa Department of Revenue did a very good study on their historic tax credit program. And they found that generally the economic benefits based upon the actual data that they were seeing from their tax revenues were that it depended significantly on where the projects were located. And so in some cases, the credits were instrumental in transforming a downtown and providing economic growth. And others, even though the projects received credits, not a whole lot happened. And that's sort of an indication, their conclusion, that it was that underlying economic conditions have a really strong role in determining the effect of these credits. So it's sort of, in general, if you look for literature on downtown on historic tax credits, it's positive. But our office thought that those had some caveats to them. And keep in mind that Vermont's tax credit program is slightly different than all these. Vermont's requires downtown development. A lot of other places don't have such a requirement. So, this is useful in that it provides some background on what other people look at, but it's not necessarily as specific to our program. So here, the next question was, would these projects have received or have still been built without the tax credits? This is kind of the but-for question. And one of the good things about this program is you have information on applicants who received the credit and those who didn't receive the credit. And so what we did is, for the award years for 2016 and 17, we looked at, for ones who were funded and ones who were unfunded, what happened to the various projects. So for those 2 application years, there were 37 unfunded applications. The board rejected those applications for credits. And of those 37 unfunded applications, 20 of them saw their grand lists grow from 2015 to 2019, indicating that either an improvement, something happened to the building, or there was a town-wide reappraisal that happened in the area. But furthermore, 10 of the 37 saw their property values increase by 25% or more. And that's, I think, more indicative of a building, something happening, an improvement happening in the unfunded project. And of those 10, the tax credit would have been 15% or less of the cost of the total project in 6 of them. So of the 10, about 60% of them, the credit was 15% or less of the total project cost, suggesting that if the tax credit is a smaller share of the overall project costs, the weaker the but-for argument here. So it's the idea that if your project cost is $10 million and your tax credit is $200,000, the chances of the project not happening if you don't receive the 200 are weaker, or you're more likely to have the project because it's a much smaller portion of the overall cost. But I'll note that for a lot of these projects that receive the credit, the credit is up to 50% of the total cost. And I see that Senator Sorokin has his hand raised.
Rockin.
Yeah, I may be a little embarrassed to ask this question because I represented Paul Bruin, the Historic Preservation Trust, for decades on this program, but I'm not following this analysis in terms of, you're talking about the specific project is being reappraised, or the town's you saw the grand list grow. How could one small piece of a building be determinative of the but-for test, unless you're talking just the grand list?
You don't have a
value
but-for.
for the project.
Sorry, maybe that's phrased wrongly. So maybe I'll say this again. So there were 37 unfunded projects that didn't receive tax credits in these 2 years. What we did is we looked at their property values, every one of those 37 properties. We looked at their property values.
The projects, not the entire grand
Yeah,
list.
sorry, that's miswritten. It's not the grand list. It's the project. We looked at the individual spans, the individual properties, and we saw what happened to their grand lists. And what we saw was that in 20 of the 37, we saw some growth in the value of the property.
Got it.
And so,
That explains it. But I think one thing that needs to be considered here in terms, I appreciate this report, it's very good. But my understanding on these projects is there are a multitude of funding sources that get packaged together to make these projects go. So to say a facade may have made a difference or not, 50% of the cost of a facade may have made a difference of whether the project goes, is not the complete picture, because they put all these different funding credits and loans all together to make, I mean, I don't know if you looked at the Putnam block recently, but the complexity of making that project go, it's really hard to drill down to one small credit like this and say, but for that, the building may or may not have gone through.
yeah, I think what you're saying is right. So, but it does depend on the project. For some of these smaller projects, the credit is a significant portion of the funding. For the Putnam block, for instance, very large ones, it is a very small portion of the funding. But when we're talking about what are the economic impacts of the credits themselves, it is inherent that you have to see whether the projects would have happened if the credits were not given. Because if
Okay.
they were,
Graham, we don't have a but for on this one, right?
there is no but for requirement
Yeah.
on this one.
So what you're looking at is, would this project have been built? Or would something, maybe not everything, would some economic activity have occurred in these buildings if we didn't, because it did when we didn't give the credit, which I would assume would feed in to our assessment of the value. But it,
Yeah, and in some effects, what I'm trying to highlight here is that if you essentially only look, if you take a big project, say the revitalization of a big downtown block, and you say, look at what happened to this downtown block after it received the tax credits. Therefore, we can assign all the economic benefits of the tax credits, or all the economic benefits to the tax credits. If the project would have happened in some way, or it would have found other financing, then a good chunk of those economic benefits are due to the other funding mechanisms here. And so what we're trying to get at here is that, you want to highlight the economic impacts of the credits themselves, not just the economic impacts of the project overall. Because if the project's going to happen without the use of the credits, then the economic impacts of the credit is not very much at all. And so that's what we're trying to highlight here, is that
The flip side of that is, if you said that about every single credit, then nothing would ever get built, because you're taking one credit and say, it's really the other credits that are making this go. And it's a combination of this creative financing that people put together for something like the Putnam block. I hear you loud and clear on the small projects, but they do fund some larger projects as well. Thank you.
Yeah. And I think generally, and this goes to the next bullet point, is that, and this is something that I heard from developers as well, is that for very large projects, I'm not going to say it the Putnam block, but for very large projects, they've told me that if they didn't receive the tax credit, the project would have gone forward in some way, maybe a little bit smaller, or, a lot of these very large projects have, they have consultants working for them. They have relationships with banks and relationships with various investors. And so the concept that, $200,000 or $300,000 is going to sink the project is just, it's not as strong of a claim. And that's something that even developers told me when going into the project. So all this is to say is that I think the downtown tax credits definitely have a positive economic impact, but it just varies by project. It seems as though if a lot of the larger projects would have likely occurred without the use of the tax credit, then the economic impacts associated with the tax credits are just not as big as just simply looking at the before and after of the big project. So the second part of this analysis is that, the applicants themselves, I should point out on this, there is no but-for requirement to receive. You don't have to attest that the project will not go forward like you do for VEPC or for TIF, or not VEPC, for VEGI or for TIF. And it is possible that on these unfunded applications that the board is essentially evaluating these projects and saying, you know what, they don't really need the tax credit, and therefore rejecting them. That's totally possible. But there's nothing in the evaluation criteria as part of the application that says that you need to prove that this would otherwise happen without it. But I've been told by the various stakeholders that is potentially qualitatively an analysis of what the board is looking at when they look at these projects. The second part is these projects don't often list the tax credits as an important source of their funding stream. Again, that's not necessarily saying that they are not going to use them or the project will go forward. It's just, it is interesting to see that they're not sort of saying like, hey, this is an extremely important part of our funding stack. And this goes to what Senator Sorokin was saying, these projects rely on a very complex capital stack. Usually it's about, for 2020 awards, 43% of the money came from private debt or equity. 16% of them came from the funding was going to come from the owner's actual own funds. Grants make up part of it, commercial loans another part. But you can see that federal and Vermont tax credits they're not listed as a reliance in the application. I see Senator Brock has his hand raised.
Just a quick question. I noticed on this particular slide, the but-for requirement is not an evaluation criteria, but I thought I had heard earlier that but-for was in fact being used. And so I'm a little concerned about what that issue is.
Yeah, so it's, so there's no but-for requirement. So the project does not have to say in its application, if we do not receive this tax credit, we will not build. That is something that the TIF, your TIF, you have to list that. There's an actual attestation. It's the same for VEGI. That's not the requirement here. This section on this slide was essentially evaluating the economic impacts and sort of saying, well, if they would have occurred, then the economic impacts are a little bit not as straightforward. But the other thing I would say is that speaking to the stakeholders in this who work in this area, is that even though it's not a requirement on the application to attest for it, there may be some sort of qualitative evaluation by the board that sort of looks at whether a project actually needs the funding or not. So it's not specifically stated in statute that they have to list it out or prove it, but the board, when they're looking at these things, may actually use it as sort of a reason to reject an application. That makes sense.
Especially if it's oversubscribed. If they're oversubscribed, that may be a criteria they use to decide who gets it. So Randy, I don't know if you were finished. I'm sorry.
Well, no, that's right. I, again, was also interested in the evaluation or due diligence process associated with these estimates. Are these estimates prepared by the provider, or is there some independent financial analysis that's provided? Does the board do the analysis, and what makes them qualified to do it? So I'm just wondering, are the numbers, how comfortable are we with the numbers? Are they real, or is there a discrete process for arriving at these estimates of the value of these things?
So I think I'll defer to Chris Cochran. I mean, I'm sure he'll want to comment on some of these, but I don't know how the board, if they do think about but-for at all, how they're doing so. On this one, essentially what I'm saying here is that you have a group of unfunded applications, and by looking at their grand list, it looks like something happened in about a third of them. And so the sort of, it cannot be strictly true that if all projects came to the Downtown Development Board, all applicants, and said, none of our projects will not happen if we do not receive the tax credit. What I'm saying here is that would not appear to be a true statement, because it looks like in about a third of the properties, something happened without the tax credit. It might have occurred in a smaller form, but we're in the sort of discussion about economic impacts, we're just sort of saying something appeared to have happened in some of these projects. That's not to say that in the projects that were approved, that their but-for claim is not solid. It very well could be true that in those ones that were approved, they have a stronger but-for claim. But what we know is that if it cannot be true that for all applicants that their projects would not have occurred without the tax credit. And that's what we're saying here.
All right, thank you.
Okay.
Another part on the economic impacts is that notwithstanding that these projects, so if we just put aside whether they would have occurred otherwise, the economic benefits vary significantly from one project to the next. So we know that about a third of the projects rewarded have a total project cost of less than $200,000, and they're mostly code improvement tax credits. And so an improvement to a building's electrical or sprinkler system absolutely makes a building more desirable for development, and it brings about additional safety benefits. However, the direct economic impacts of that are just smaller because they're, relatively small in scope. To the extent that the building would have completely fallen apart without the sprinkler system or things like that, that's very important. But the direct economic impacts related to that are essentially just the electrician's wages that you're having, do the electrical system, or the contractor that puts in the sprinkler system. But the sort of wider spillover effects are just a little bit more limited. We compare that to projects that have over $1 million in project costs, which are about 26% of total credits. Those are major revitalizations of a downtown building or block. And those are much more likely to carry not just greater direct impacts, because you have more people working on the building to make that improvement, but also greater spillover effects. And so you're more likely to get, various revenue streams, meals and rooms taxes or sales taxes from those. You're more likely to see if the building is improved, it might improve an entire block, spillover effects like that. But from our analysis, it's those projects that have sort of a weaker but-for argument. And so that's something that we want to take into effect when we're talking about the economic impacts of the credits themselves. And it does seem to look like, while the board does fund a wide variety of projects, the board is much more likely to approve applications that are large. So if we look at the funded and unfunded applications for 2016 and 17, there are about 76 total applications between unfunded and funded. 39 were funded and 37 were unfunded. And for projects less than $500,000 in costs, there were 52 projects that were applicants. 21 of them were funded, but 31 were unfunded. So a majority of the projects under 500,000 of the applicants were unfunded. But if you look at the projects with greater than $1 million in project costs, there were 13 of those, only 2 got unfunded. So it seems to be that the board does tend to go towards more of those community revitalizing larger projects. And I would also add that these projects are much more likely to have more solid applications. They have consultants working for them, putting together the applications. It's part of a larger funding stack. It's a big, they're more likely to have coordinating developers and things like that. And so their applications just might be better. And that's why the board is approving them. But it does seem as though larger projects are more likely to be approved than smaller ones. And then the final thing I want to touch on the economic impacts is that there are indirect economic impacts associated with these downtown tax credits that are mostly due to the economic benefits that stem from driving development to downtowns. That unquestionably has a good economic impact to it. So it's what we call sort of smart growth, and that's in actually the statute is the designation for downtowns and village centers. They want to create this sort of smart growth, and there's lots of indirect benefits to that. So you have increased housing options for residents. So instead of sprawling, in a sprawling community, zoning restrictions are likely or put restrictions on the type of multifamily housing units. In downtowns, that's less of an issue. You have definite transportation benefits, so it costs less for residents to get to their jobs. There's improved fitness, reduced traffic incidents, all good things. There's a more efficient provision of public services, so utilities, roads, emergency services are easier to provide when the communities are denser. And then there's environmental impacts, so less need for cars, release, is fewer emissions, fewer impervious surfaces, so economic or environmental impacts there. And then furthermore, there are a lot of studies which highlight the benefits of density and of people being closer together, sharing ideas, working together as a community. Those are all very good things, very good reasons to have more denser downtown development. So that's something that the Downtown and Village Center Tax Credit Program, because it's a downtown tax credit, is essentially bringing. So moving over to our fiscal impacts, I first want to caveat this by saying that generating a fiscal return on investment from these tax credits is not a statutory purpose. It does not say a goal of this tax credit is to make money for the state. And there are lots of programs in the state that don't make money for the state. We just do them because it's a good thing to do. It's good policy. So I don't want this to be construed as sort of saying this is not this is a reason to not do the program. But it's something we looked at because it's something that we typically review when we do tax expenditures. And then, some economic development programs are promoted as being self-financing. So even within the materials from the Downtown Development Board, they sort of tout the economic or the grand list growth in some of these properties as sort of a benefit for why the state would want to continue investing in these areas. But what we found in general is that this program is unlikely to be generating a positive fiscal return on investment for the state, fiscal return on investment, at least in the near or medium term. And the way we looked at this is we first looked at the grand list growth. This was the primary driver for what the fiscal impact, the grand list growth across all projects approved and from fiscal year 2014 to 17. So there's a list of over 100 projects there that we're looking at essentially. And then we looked at the grand list growth for the funded versus unfunded projects from 2016 and 17 to sort of make a comparison of did the downtown tax credits for the funded projects create significantly more grand list than those that were unfunded. So we have 107 projects that received tax credits that we could identify their span numbers for their property values from fiscal year 2014 through 2017. And over that time period, $8.9 million in credits were awarded. So from the years 2012 through 2019, properties that received the tax credit grew, the total property value growth was $24.7 million across all those properties from 2012 to 2019. What that translates to is roughly $500,000 in annual property tax revenue. And so you can see here that if we were spending 8.9 million credits, it would take a decent amount of time, even before accounting for the time value of money, to make up that money. And 26 of the 107 projects did not experience any growth whatsoever. So they received the credit, we looked at their grand list, and nothing happened from 2012 to 2019. And a further 26 experienced decreases in value, which is, it's not clear to me how that happens, but it's possible that some of these tax credits, though they didn't grow the grand list, they prevented or arrested the decline in value. That's possible, but you can see in table 8, we lay out essentially the tax credit award year, the total grand list growth from 2012 through 19. And then we just lay out in the final 2 columns for projects that had with less than 10% of the cost share and for projects with greater than 35% of the cost share. So in projects where the tax credit was less than 10% of the cost share, it seems as though those are the ones that are driving the grand list growth. And those are the bigger developments because the tax credit is such a small portion of their overall cost. And those are much more likely to be big projects. And so you're getting a lot of grand list growth from those tax credits. But for those with 35% or more of the cost share, those are your, mostly your code improvements in the smaller buildings. They're not generating a whole lot of grand list growth. You're mostly getting grand list growth from your big projects here. And the second line of analysis is to take a look at what happened to the grand list growth for those projects that were unfunded versus those that were funded from 2016 and 17. And what we found is that for those projects that were funded with tax credits, they generated modestly more overall property growth than their unfunded peers. So essentially the annual property tax benefit from the $4.6 million. So over those 2 years, we as a state awarded $4.6 million in tax credits to the funded applications. But those funded applications generated essentially an extra $100,000 in property tax revenue per year over their unfunded peers, if that makes sense. So to put it another way, the average credit awarded by the state over those 2 years was $117,948. And for the projects that did receive the credit, they generated about $2,000 more in property tax revenue relative to the projects that did not receive any tax credit. So if we look at table 9, you can see for the funded projects, they generated about $9.5 million in grand list growth across them, which is about $205 million or $205,000 in total property tax collections. For the unfunded projects, they generated $6.6 million in total grand list growth for $105,000 in annual tax revenue. So you're talking about spending $4.6 million for roughly $100,000 of extra tax revenue. Again, this is it's very possible that the unfunded projects were not funded because they didn't need the credit or they were much, and so you essentially the fiscal benefit here is a little bit skewed by that, but it's just another way of comparing essentially what the state is getting for spending the $4.6 million across those 2 years. Are there any questions on this on these analyses before I go on?
I do, Madam Chair.
Yeah, Senator Pearson.
Graham, this does not seem like a resounding success, what you're laying out here, fiscally speaking. It's been important in revitalization, and maybe there are tangential benefits, but pound for pound, this is not a great return on investment for the state, right?
I don't want to say pound for pound because lots of state programs don't return, state investment, don't return fiscal investment. So, and I don't know what the returns on investment for fiscal, what those would be. All I can say is that from a fiscal perspective, you would not do this program if your sole goal was to make money from tax credits. It does not appear to be generating significant, certainly property tax revenue growth by spending the money. And that's not necessarily to say that the tax credits aren't worth your time. It's just maybe there's not issues, but more fundamental things at play. So, for instance, if you sink state tax dollars into a project in an area with very low economic growth, your corresponding grand list growth is just not going to be that large. That doesn't mean that you shouldn't do the project. But from the fiscal perspective, I think what you're saying is sort of mostly correct in that if your only goal as the legislature were to make money on these projects, on these tax credits, you're likely a long way away from doing that.
Well, let me ask you a related question, if I may. We are deeply interested in stimulating housing. Do we have any kind of an analysis that suggests, this is a vital piece and this is one of the more cost-effective ways to stimulate housing development? Or, is the analysis that this is how you keep developing housing downtown versus out of town? I mean, if somebody's reading this and emails me and says, why do we keep doing this? How would you answer them?
I would say that if the legislature has made a commitment in 24 VSA 90 something, the downtown designation, the desire to improve economic development in downtowns. That's sort of a decision that the legislature has made. And the question is, how do you best go about that? I would say that even though this program is not necessarily a fiscal return on investment, it's not a reason not to do it. And I would say that it appears as though the downtown tax credit program is probably as good as it's going to get, because it's such a simple program. It allows people to access the money effectively. It's going to the areas of the state that are right. Just because something isn't returning a fiscal return on investment doesn't mean that you don't do it. I'll give you a good example. The state funds roads that go through various towns all the time. That doesn't mean that you shouldn't build the road if the road, you can't generate the tax revenue associated with it. So that's one of the fundamental goals, or I think, of government, is to fill those areas where the actual return on investment might not be there, but the positive externalities of doing so is. And so that's why you would keep doing this program.
Thank you.
Okay, any other questions?
Madam Chair.
Yes, Senator Hardy.
Thank you. Graham, you mentioned some of the other, just to carry on this theme a little bit, some of the other benefits to our downtowns, the environmental benefits, the housing, the transportation, that type of thing. Did you attempt to put any kind of dollar value on those to sort of add to the fiscal impact, or was it's just too difficult to do that?
For those ones, I think it's too difficult to do that. And I highlight that on the next slide, is that, so we only really looked at the property value, so the property tax growth here. So the first thing I would say is that for many of the projects, the post-credit improvements are not captured on the grant list because they're not reappraised. I don't know if you're even required to get a permit if you're going to redo your electrical system. So the town doesn't even know that you've even made the improvement. The time period analyzed could be too short to show grand list. So you might see that when the town does reappraise, town-wide, or they're going to reappraise the property, that they realize that it's vastly improved and they're going to, put that on the grand list. We chose a 2012 to 2019 period because that's what the data was available to us. But it's possible many years down the road, when the property sells, it'll sell for higher because it's more up to date. And these analyses don't take into effect the other revenue streams. This is kind of what you're talking about here, is that, the benefits of increased sales, meals and rooms, income taxes from paying the contractor. Those definitely exist in some of these projects. So this is the Putnam Block in downtown Bennington. Those will definitely exist, and those will benefit the state. The key point I want to make is that you have quite a bit of ways to go to get a fiscal return on investment, at least in the short and medium term. And so it does seem kind of implausible that even with those, if property tax is sort of the most direct measure of the fiscal return on investment, because it is the one that shows the improvement the quickest and likely the largest, then it seems implausible that those sort of secondary revenue impacts would be enough to sort of make this put it in the green in the short term. So again, that's one of those things, though, that the legislature absolutely values development in downtowns. Putting an actual number on that is really difficult. But once you make that you make that decision as the legislature, notwithstanding the fiscal return on investment, these are, I think, probably one of the best ways you could funnel the money into downtowns.
So I appreciate that last comment. I mean, I guess there's more value to this program than just dollar return. I just look at the Putnam Block. How do you value quality of life? Bennington could have died. To put a value on that.
Yeah, that's the fundamental issue here, is the measurements that we have for the fiscal side on this are showing that it's not going to generate more money for the state. But all I'm saying is that's not a reason not to do the program. I mean, and I always stress this when we talk about TIFs, is if not TIF, then what else, right? So if you decide that as a legislature that you want to provide money to your downtowns, the legislature has decided to do it in the form of the downtown tax credits. How effective is that program at getting the money there? And I would argue that it's very good. What other program might you use? Well, you could use a grant program, but you would definitely not be getting the fiscal return on investment from a grant program as opposed to this. It's just a fundamental issue with investing on these projects. The fiscal return to the state is just not going to be there regardless of what program you use. So would you rather have a program that's much more complex, that's more difficult to get money into people's hands who need it quickly? Or would you rather have a program like this where it seems as though it's working quite effectively at getting the dollars into pretty meaningful projects?
Remember, when we started all of this, our downtowns were deteriorating. There were shops boarded up, and you get in this downward spiral. And this was really the state's effort to say, look, we think they're worth saving and we're willing to put some money into it. And it helped. Was it the sole cost? I don't know. But our downtowns definitely look better than they did 30 years ago. I mean, I remember Montpelier when we moved here. And facades are important. Curb appeal. It causes people to want to go in and see your shop. If it looks like a dump on the outside, they probably won't. So, but remember where we were when we started this. We still do have some fairly rough downtowns. And we have some small stores that are really struggling. And they don't have the extra money to do away with the, knob and tube wiring. But if they don't, they might burn the whole thing down. But that doesn't add to your value, really. It's like replacing your leaking roof. It's just general maintenance. A new facade, on the other hand, does add to your value. So maybe we need to put more money into facades.
Yeah,
But
I think that's an excellent way of thinking about it. When I was explaining this to various people who reviewed it, I mean, and a good example is a wheelchair ramp and a business. That's not going to provide the state with much fiscal benefit, but it will make obvious benefits for people with accessibility concerns. And so again, there are lots of things that will not generate a fiscal return on investment. That's not a reason that's not the reason for not doing them. So.
Madam Chair,
yes,
you've often remarked that this was an alternative to building housing and shops out in the cornfields. And our policy is to push things to downtown when we can. The word facade has been bandied about today, and this is a tax credit. And it comes out of revenues before they get into the treasury, which is sort of a facade for a grant, if I might add there. But it takes existing second and third floors that have been standing empty often for decades, and will continue to stand open, and without fire escapes, elevators, sprinkler systems, modern wiring, and contemporary plumbing. And the value, there's value in not having things built out in the cornfields with their they too require infrastructure and expense and ruin cornfields. So
and they're cheaper.
Which is, I think, why the program is flourishing.
Right.
Okay. We have another we may have to put it off since it's on 4:15, and I'm not even sure, Graham, you've finished, but Senator Bray has a question.
Well, it's not a question. I just watched downtown Bristol go through another round of downtown, I think the money came through this program. They had done curb cuts and all that stuff before, but the brickwork had degraded, things were uneven, all this kind of stuff. And so they did a lot of nice work this summer with curbs. And the only thing Chris Cochran's on the call with us, so I'm going to lament out loud that I wish they would consider a little less lighting. I don't think you have to be able to read the 6-point type everywhere in downtown. I'm not sure why it's quite so bright. And trees, there are no new, all the trees that were once there are gone. And I just would hope that one of the things that makes certain older towns so much more pleasant is to have a little natural shade here and there. So I'm just weighing in on behalf of trees, and maybe we don't have to read 6-point type at 1 a.m. in the morning everywhere in downtown.
I believe there are traffic standards for lumens. The city of Montpelier is not overly fond with the number of lights in the Capitol complex it takes to get the requisite number of lumens, because you've got probably twice as many poles.
Yeah.
So there's a balance there. I don't know if Bristol's got more lumens than the traffic standards require, but I know there are requirements, having replaced poles.
Madam Chair, I don't know if you can see people, but Chris Cochran's had his hand up for quite.
No, I cannot see Chris.
Good morning, Madam Chair and the committee. My name is Chris Cochran, and I'm the Director of Community Planning and Revitalization, and I worked with Graham on this report. And yeah, you've had several questions, and I can probably answer them quickly. One was, I think in the very beginning, is whether individuals can buy these credits. They cannot. This was aimed at just keeping the universe small to minimize fraud. So you can only sell them to banks and insurance companies. That was the intent of the program. The auditor several years ago wanted to take a look at the program, but the deputy auditor said this program, she was a former employee of the tax department, said this is one of the most effective programs in the state of Vermont. Don't waste your time. It's doing what it's supposed to be doing. The question most recently, I guess, about the return on the investment, to your point, many of our downtowns 20 years ago were in horrible condition, and they were in terrible shape because the dollars and cents to rehab these buildings just didn't make sense. So without a subsidy, we weren't seeing the investment in the improvement of these buildings. And I would love to follow up with a presentation showing you some of the before and afters of these communities. Lastly, to Senator Bray's question about trees, we do not design the projects, but what we do is try to craft the incentives to get the right answers. And one thing that you'll know recently that we've done is we're adding clean water funding to the Downtown Transportation Fund. And we're hoping to see more green infrastructure opportunities within our downtowns to kind of sink and sink the stormwater that would have otherwise gone down the storm drain. And one of the best ways to do that is by planting trees in our downtown. So we will see that change with time.
Thank you.
Brock, you I can see. Senator Brock.
Just a question, Chris, for you. There was a view apparently from the deputy auditor at the time that this particular program was creating significant dividends. How does that compare based on your observation of the TIF program that certainly affects a number of our downtowns as well?
I don't have expertise in the TIF program, so it's hard for me to compare. I wish, these look at individual buildings. The TIF program tends to look at infrastructure. I mean, they're certainly related, but I've never seen any analysis looking at the which is more effective. They're kind of looking at related issues that you can't increase the density of your downtowns if you don't have a sewer and water system that works. You can't build new buildings unless these other pieces are taken, working together to support the built above ground infrastructure, but I haven't seen any comparison of the two. Sorry.
Yeah, I'm just a little concerned about the position that, seems to be taken, that these buildings do affect future increases in value and are cost effective. But, where's the evidence to show that any more than the same evidence, let's say at a TIF program, that you may go back and look at a TIF program 10 years later and you see a community that's much more vital than it was before. But how do you say that, well, that was a result of the infrastructure added in the TIF program, any more than you say that that was the result of the facade improvement in the downtown tax credit program? How do you know that was the reason why the rest of the downtown is much more prosperous? I guess that's kind of a rhetorical question for you.
Fair enough. It's hard. I mean, on some of these economic analysis, we don't have a very big program. We just increased the cap to $3 million a year, $3 million a year in the total, multi-billion-dollar grand list of the entire state. It is not often a big enough investment to really move the needle. But when you look at, because we're working in such tight geographies, these small historic commercial centers, I think over time, you certainly see the appearance. Why the property tax values are lagging so much, I think Graham points out, is some of the things we're paying for are needed public safety improvements that just don't really return much to the value of their building. But on that note, these public safety improvements that we, like sprinkler systems and things like that, they do often save the state money in the long term, because when these buildings burn down, the first person they go to seek money is the state to say, we need this building replaced. And those are very, very expensive projects. And in fact, that was the genesis. We were having so many downtown fires 20 years ago, and we needed more sprinkler systems to protect these important assets, because once they're gone, and then they're very, very expensive to replace.
Thank you.
About how much further have you got to go here?
I've got 3 quick slides.
Okay.
To wrap it up here.
And then, we'll see what the time looks like, but it's almost 4:30, and if it's going to take anywhere near this amount of time, I know some of us have a 5 o'clock meeting, so maybe we'll just finish this one up and then do clothing and footwear another time.
Yeah, I think the clothing and footwear one will be shorter, but half an hour might be pretty tight. But I think I anticipate some questions. It's not as long as this one. This one was much more in depth.
I don't think it's quite as complex as this
Exactly.
one. Okay.
So we had 3 what we call considerations for legislators to think about, and generally I think they're pretty benign. The first are clarify the program statutory purpose. So it's relatively vague. Certainly in Title 32, the only thing we see there is improve or help make the incentivize improvements in downtown areas and historic buildings, but that's relatively vague. There's no measurable goals there, so that would be helpful for evaluating it. But then there's just other things. So should the credits be focused more on improving historic buildings in areas in the state with slower economic growth? That's not something that's spelled out in statute. And so, when we're evaluating these, I sort of marked down as, I noted that a lot of the credits are going to areas of the state with slower economic growth, but is that a goal of the legislature? Do you want some of these to go, do you want half of them to go to Burlington's area or not? So, just a question that would help evaluating. Should the board only award tax credits that will maximize potential economic benefits? So we highlighted this as, the tax credits go to a wide range of projects, and the larger ones we think are the ones that return the biggest economic benefits. But that doesn't mean you shouldn't do the smaller ones. And so maybe some statutory clarification around what the legislature wants. They want to maximize those benefits, or are they okay with going with some smaller projects because you still feel those are important? Is it a purpose of the tax credits to generate a positive fiscal return on investment? Again, that's not spelled out in the statute. It's not a statutory purpose. It's something we evaluated and found that it was not. But to the extent that the state wants a fiscal return on investment, it's something that it should be written in statute, or, because for instance, in the TIF program, when we're charged with evaluating that program as part of the TIF report every 4 years, we're required to analyze the fiscal return on investment. No such requirement is on this program. And then just think about, are there more efficient ways? Think about the goals that are laid out in Title 24 for the downtown designation and the village designation program. There are more efficient ways of achieving the goals laid out. My interpretation or my judgment on that would be not a whole lot more efficient ways, but think about it. Think about the downtown tax credit program relative to, say, a grant from the state to various, or a competitive grant process. Would that be more efficient? I don't know, but just something to consider. To the extent that the state wants to improve the fiscal return on investment, so again, this is not a goal in the statute. The legislature might decide that no fiscal return on investment is just fine. But we were just looking at some of the issues we saw in this, and as we were analyzing this, and you might improve the fiscal return on investment by requiring the projects to be reappraised as soon as they're done. And that might be a way of just showing, improvement to the grand list quicker than what is currently there. And so you might, even though some things might not move the grand list much greater to generate a positive return on investment, you'll just see more benefit quicker if you require a reappraisal, especially on these smaller code improvement projects. And then another thing that we saw when we were looking at other states is that some states limit the credits availability to nonprofit entities, because many of these entities do not pay property or income taxes. And so if you're going to give a credit to a nonprofit entity, just be aware that you're going to receive no fiscal return on investment from that tax credit, or very little. They would mostly just be indirect stuff. And the third was just clarify the definitions of the type of building the program is intended to serve. So the current statute says that a building must be 30 years old at the time of application to be eligible for the credits. And so what that means is that, even though most of the buildings that receive credits right now have been built before 1930, so they're all relatively old, more and more modern looking buildings will become eligible for these credits, something that you would not consider quote unquote historic. And one thing with that current statute is that it does not necessarily account for the change of pace in code regulations and the cost necessary to make code improvements. So I made the example that it costs less to bring a building up to code that was built in 1982 as opposed to a building that was built in 1902. And so both of those buildings will be eligible for credits under this program. And so just thinking a little more critically about, that sort of nuance might be important. And then just to note that the number of modern looking buildings in downtowns will become more eligible for these credits over time. And so you might start seeing buildings that most people would not consider historic at all receiving some of the credits. And, historic is kind of in the eye of the beholder, right? You might see something that's looks like an 80s, really not good looking monolith that is receiving these tax credits. But it might be the legislature's intention to really target things that are, more like historic to the downtowns, like the sort of classic downtown blocks or Victorian buildings, things like that. So just be aware that this current statute, you're more and more likely to see, buildings that may not be considered historic in the sort of traditional sense. So that's the end of the presentation. So.
Okay. Graham, have we done any analysis, and maybe Chris, I have a feeling that there are other grants that go into these. Those second and third stories frequently get the affordable housing tax credit, which is the one we've used a lot. And then there's a transportation, I don't have anybody here but that can do street improvements or bike path kinds
Right.
of things.
The downtown transportation fund is what you're talking about.
Is there, that's
Mhm.
not the name that rings a bell, but there are other, there's credits that this probably didn't build the curbing in Bristol, which is
No.
impressive. This, but yeah, things like rewiring in an old building, again, I can build with new wiring outside of downtown, and it's a lot cheaper than having to go up through the walls and rewire. And we won't even talk about the cost of putting sprinkling into older buildings, apartment buildings. When Montpelier everybody had to have sprinkling, it added thousands of dollars to the price of every house. And that's new construction. So it might be good to think about those kinds of things, sprinkling, wiring. They're not sexy, but they're essential, and they tend to cost a lot. And, we might take a look at that and take a look at other grants, because these can be extremely complex packages that get put together. And this is probably a very small part of some of those grants. So maybe we can look at that.
And as Graham noted, the impact varies depending on the community. Like lately, we've been doing a lot more investments in downtown or small village stores. These are huge, important connectors to the community. And they're often taken on by, nonprofit groups who just, they want a store. And where I live in Calais, there's a group in East Calais, the store's closed. They've, taken this, our credit
I've been
was
trying to sell that store.
well, they bought it now. So they bought it, and our tax credits were the first thing in their stack because there's really no risk for us. We want to support their project, to spark their revitalization, to give them some confidence. And often it leads and gives them the credibility they need to go to that next person, to VHCB or to some other group and say, look, we've got a real project. We've got some there. Or in this case, the community is actually reaching out to the members of the community to raise money to get the store back open again. So they are really important things. Does the state make a ton of money off of them? I kind of concur with Graham, probably not, but we have to look back at what the value here we're trying to support with these investments. These vital, important, active downtown and village centers underpin our economy, our brand, our quality of life. And when they look terrible, are these places where you want to come live? Is this where you want to start your family? Is this where you want to work? So I think, to your point, appearance does really matter.
Yes, you have to drive 15 miles to Montpelier for a gallon of milk or a loaf of bread. And they do tend to be gathering spots. But they're old and they frequently haven't been maintained, and we won't talk about the tenant in the third floor I never could even get up to see. They can be challenging. So Senator Bray.
Yeah, Chris is reminding me of, I forget when it was, maybe a decade ago, that I think it was National Geographic, I forget the organization, that declared the entire state of Vermont to be like a national historic site or something along these lines, exactly because we had all these old downtowns separated by green spaces, and that traditional pattern has been lost so many other places. But the surprise to me was that it wasn't that they said, oh, just Montpelier or just Bristol is nice. And they said like the whole state. So it's easy to undervalue what so many other people have lost.
But if your downtown looks awful and depressive, then people don't want to live there.
Yeah,
I think that's the value of. I don't know which country store we were looking at in Graham's slides, but it was very attractive. And if I came into town and said, oh, that's nice, and that tends to get the people next door under a little pressure to paint their shutters, and and that loss of a store, I know Cabot has been struggling, trying to keep their I think their general store closed. I know they've been working on it. The community bought the general store post office in Maple Corners. So
A great recent success is Albany. You know, people had to drive like 25 miles to get milk or a sandwich, you know, and it had been closed for 4 or 5 years. I'll share pictures if you want to see them. You know, it took them a long time to raise that money, but they did it. You know, there was gas pumps there, so they had to do brownfield remediation. They had, you know, it was just a very complicated project, but they, you know, they're wrapping it up now, and it should be open this spring. And, you know, that's, you know, where I live in Calais, you know, it's the store and the dump is where you connect to your neighbors and kind of get your sense of community. And so without them, it is a real loss.
there was music to go to the dump by many years ago. John Nutting did the recording. Senator Hardy.
Thank you. I just had a comment and a question for Graham. First, there are obviously lots of benefits to this program that are beyond the fiscal benefits, but at the risk of irritating Senator McDonald, as a former fiscal analyst, I'm going to thank you for the fiscal analysis of it, because I think it's really important that we look at that as well, and the economic benefits or not benefits. So thank you for the analysis, even though there are obvious benefits beyond money. But my specific question is, one of your considerations for us was about reappraisals, and I could be mistaken or just misunderstand. I thought that if you got some kind of permit to do a renovation, that there was some kind of trigger to require a reappraisal after the work was done. Is that not true, or is that for another purpose?
Yeah, I think that's correct. I don't know how it works in every town, but generally when you make a large improvement, you apply for a permit, and then the permit is sort of the tip off to the town to look at your property again. And what we're sort of saying here is that for a lot of these smaller projects that do code improvements, say like rewiring, getting rid of the knob and tube, that might not be something that requires a permit. And so the town just does not know about the improvement to the building, and therefore just doesn't appraise it. I don't know to the extent that occurs, but that was our theory by looking at a lot of these code improvement projects and seeing that there was no grand list growth happening before and after the tax credit. When we know for a fact that the building is improved in some way, shape, or form, that's what the downtown tax credits are doing. But what we were thinking was, well, if it's a smaller code improvement project, they might not be triggering those reappraisals and therefore not, showing up as grand list growth. You might see that grand list growth several years down the road when you sell the property. You can say, well, look at the building. It's got an updated electrical system. That's a good thing. It sells for higher than it would have otherwise. But a way that you might consider to improve that fiscal return on investment is for these code improvement projects requiring, that the town reappraise the property if the building received a downtown tax credit. I'm not saying that you would generate a ton of fiscal return there, but it would be a way of perhaps capturing because we know there's improvement that happened. It'd be a way of sort of capturing that on the grand list a little quicker.
Okay. And this is in instances where it's not already being reappraised because of permitting.
So in a case where the building goes through a much larger, or a bigger change, say it does an addition or adds a unit or something like that, and then it also gets a new sprinkler system, that would probably trigger a permit, and it would probably trigger a reappraisal. Again, I can't speak to every town, but that's my understanding of how this would work. And so you'd likely see in some form the benefit of the downtown tax credit showing up, on that reappraisal. But the problem is on a lot of these the code improvement credits especially, they're very beneficial. They improve the building, but you don't see it on the grand list immediately. For almost a lack of better term, no one knows about it.
On some of these, tax stabilization is part of the package you negotiate with the town.
Correct.
You
Yeah.
can't do the schools, but you can negotiate the tax stabilization with the community. So they get to be very complex packages.
Well, and that's a fair point. It's one of the reasons, when Graham shared his findings, I'm like, there's a lot of things that affect reappraisals, and oftentimes, I think I cited Barry, we made a significant investment in that building, but because of a tax stabilization and, agreement, it didn't show up in their grand list.
Is that the Lang?
It's the one next to City Hall.
Yeah. That, it was an old furniture store, and the top 4 or 5 stories were used as storage. And it's worth walking through. They have done a magnificent job.
The upper floor was like a top floor was a mason's room, and it was just beautifully.
It was,
it was just beat up. It was
one of
it
those.
looks great now.
Yeah, they have done, and they've maintained some of the old industrial architectural things, but that one I know there was a tax stabilization on. But we don't always do things to make money. And there is I think a good part of this has been to encourage people to invest in downtown, where it is more expensive to rehab than to build fresh. And I know with one of the original affordable housing credits was Elm Street in Montpelier. All that affordable housing along the river, which I had the pleasure to walk Governor Dean through after the flood. The gas lines that heated that place were, Rube Goldberg could not have done as well. And why it didn't burn down, I don't know. But 2 or 3 private investors had looked at that block, which is very narrow, right on the river, and they could not make it work financially. And it was only a group of citizens who were, I think, might have been one of the first or the first to work with these tax credits and put together a package to rehab that housing. But, and they saved everybody, people that were paying $300 a month in gas bills were paying $300 a year when they finished. So a lot of it is that we couldn't get private, and that's probably the affordable housing credits more than the downtown, but they frequently are combined to put together a package. Okay, Senator McDonald. I know you don't have any 3-story buildings or any traffic lights.
No, I'm not, Madam Chair. Yeah, we don't have traffic lights, but one of the aspects of this downtown project is if we do nothing, many of those buildings are abandoned or unusable, and they're sitting there. And if you don't do anything, you're going to have to tear them down, and then what do you have? You can take the old Mason's place and call it a loft and try and sell it to someone from southern Manhattan. But it's money well spent, and it prevents the degradation of downtowns. That's the cost of not doing anything is often more expensive to the community. So, thank you. That's enough.
Yeah.
Yep.
We still have a vacant lot in Montpelier from a building where the owner couldn't fix the roof. The roof leaked for enough years until the building wasn't structurally strong enough to hold. The back wall was actually listing out. And eventually it had to be taken down. And if a roof had been put on that 10 years earlier, it probably could have been saved. But we still have a vacant lot because no one's been able to afford to build there. The other one downtown was burnt. But that one was just lack of basic structural, wouldn't have added any value to the building if it had been done when it needed to be. And it does have a cost. Okay, everybody looks substantially glassy-eyed. I think, Senator Pearson, you can take us off live.